All right, so that first one, the buyback. Okay, so your journal entry for a stock buyback. So we have to give cash. We're giving up cash, so cash will go down, and we're getting what is called treasury stock. Treasury stock to record company shares repurchased at market price. So let's just say that we repurchased 50,000 shares at market price of $1. Okay. 50,000 and 50,000. Okay, there it is. Now, treasury stock, this is a new account for us. New account for us. It has a normal debit balance. Normal debit balance. It is a contra equity account, right? It's dealing with stock, so stock is equity, but it has a debit balance, so it's a contra equity account. And it's going to appear on the balance sheet. I'll show you what that would look like. Remember, we started a balance sheet a couple videos ago right here. So there's your equity. We said there's two components to equity. If a company has treasury stock, you'll say less, just like you do with all contra accounts. Treasury stock. Easy peasy. All right, so there's some fun facts about that new account for you. We said most companies buy back their stock with the intent to resell it later. So let's look at that next. So our journal entry for resale. So maybe we buy it back on January 20th, on January 31st. We feel like, yeah, the stock price has rebounded. We want to resell it. So we get cash this day. We're selling off our treasury stock. Okay, let's give you some info here. To record resale of treasury stock when market price is $2 a share. Okay, so the cash that you receive is always market price. Let's say we resell all 50,000 shares we'd previously reacquired. 100,000. Now treasury stock, that's going to be the amount that you repaid, right? So when we repurchased it, we paid $1. Okay, so that is the amount we use. Why, in case you're wondering, we don't use par value, is the method. We're using the cost method. The par value method you cover in a more advanced class. Okay, so if you remember before, in this example, our par value was 50 cents. When we deal with treasury stock transactions, you don't use the par value, okay? No par value used for treasury stock transactions, okay? Remember that, because they're going to throw it in and try to confuse you. They will give you the par value. You simply use your reacquired price, and that is your cost. Obviously, debits have to equal credits. There's an account that we use whenever the market price is greater than, in this case, the cost. It's the APIC account. APIC goes for every single class of stock. So APIC treasury stock for the difference. There you go. Now, this was a happy resale, meaning the cash we received was greater than what we paid. Could we resell it below what we paid? Yes, we could. Okay, yes, we could. Okay, you can sell treasury stock. You can sell it for below your cost, your reacquired cost. So resale of treasury stock below cost. It is permitted, okay? So this is permitted. I just didn't want you to get confused because remember we said that the par value is the minimum sales price, right? That's for initial issuances only. So we're not initially issuing this stock. We'd already issued it once to the public and then we bought it back and now we're selling it again. So we can sell it below our cost. We could even sell it below par value. Okay, obviously it's not recommended, but you could. Okay, so it is permitted. It doesn't violate any state laws. It is permitted. Okay, if you do sell below cost, you're going to have a loss, right? This loss will come out of the APIC Treasury, APIC Treasury stock, right? So if you have a gain from reselling your Treasury stock previously, so yeah, it would be on the credit side, right? Because it's a credit normal balance. You first use it up. You can use up as much as you have in there to bring the account to zero, okay? But if there's an additional loss not covered by the balance, in the APIC Treasury account, then retained earnings must be used. Okay, just want to point that out. You do have that in one of your homework problems. So unless you watch this video, I don't think you'll get it because I'm not even sure if the book covers an example of a sale below cost that exceeds the balance. I think all their examples are like happy. It just is exactly what the balance was. So in reality, if it exceeded it, you have to use retained earnings, which makes sense because it's all coming out of equity. So we're saying you've used up all your APIC treasury stock. You can't dip into other classes, but you can take out of another component of equity, which is retained earnings. All right, guys, you are done with chapter 14. Do the homework assignment. No quiz of this chapter, just do the homework assignment, which covers all the journal entries that we did. You'll have an issuance, you'll have a treasury stock buyback, and then you'll have a resale happy situation where it's above what you paid and a sad situation where it's below cost, even to the point of exceeding your balance. So then just remember to use retained earnings.